Good morning, good afternoon, or good evening, depending on where you are dialing in from.
Oh.
Welcome back to Talk Tickers.
Hello, everyone.
This is the show for the experienced investor, the analyst, the portfolio manager, and anyone who's just obsessively curious.
That's us.
That is us. We're here to strip away the corporate fluff, ignore the PR spin, and get straight to the numbers that, actually move your portfolio. I'm your host, and today we are looking at a ticker that is giving everyone a bit of heartburn this morning.
It is certainly a fascinating setup today. A real head scratcher if you only look at the surface, but once you start digging, it makes a painful amount of sense.
We are looking at QSR. That's Restaurant Brands International.
The parent company of, well, the Holy Quartet now. Burger King, Tim Hortons, Popeyes, and Firehouse Subs.
And context is everything here.
Sure.
It is Friday, February 13th, 2026. The market is currently digesting the Q4 2025 print that was released earlier this morning. And let me tell you, it is a bloody Friday out there for QSR holders.
It really is. It's a classic good news is bad news scenario, or, perhaps more accurately, headline news is good, but the footnotes are terrifying.
Exactly. On paper, if you just glanced at the terminal while sipping your coffee, you'd see a beat. They beat the street on the top line, they beat the street on the bottom line, and yet the stock absolutely puked.
It did.
It's down over 6% as of the close, sitting around $66.35.
And the volume was massive. We saw about, 9.1 million shares trade hands today?
That's huge.
That is roughly 3 times the average daily volume. And that tells you something important. This isn't just retail panic. This isn't just some algorithm tripping over a keyword.
Yeah.
This is institutional rotation. The big money looked at this report, saw something they didn't like, something structural, and they just headed for the exits.
So that is our mission for this deep dive. We need to dissect why a double beat on revenue and ETS resulted in a massive sell-off. We're going to look for the rot underneath the floorboards.
And I think we know where it is.
And from what I've seen in the transcript, it seems to smell a lot like expensive beef and a tapped-out U.S. consumer.
That is the core of the thesis today. We have this massive divergence. You have the international growth engine, which is, it's firing on all cylinders. It's essentially a different company.
A completely different company.
And then you have the domestic U.S. engine, which is sputtering, coughing, and stalling due to these inflationary pressures that just won't seem to go away.
All right, so let's start with the headline numbers. The beat, that wasn't enough. Walk us through the snapshot of what they actually reported this morning.
So the headline numbers were, objectively solid relative to consensus. Adjusted EPS came in at 96 cents against an estimate of 95.
A penny beat.
A penny beat. Now, a penny beat isn't going to send a stock to the moon, but it usually prevents a crash, right?
You would think.
And then revenue was $2.33 billion versus a $2.28 billion estimate. That's a solid $54 million beat. That is up 10.1% year over year.
Double-digit revenue growth.
Mm-hmm.
Usually that's a celebration. In this market, if you're printing double-digit top-line growth, you're usually getting a premium multiple for that.
Exactly. And system-wide sales were up 5.8% year over year, and global comparable sales were up 3.1% for the quarter. Brand by brand, international really shone, with comparable sales up 6.1%.
So if you just stop reading there, you'd be buying the stock.
You'd think the stock would be up 2 or 3%. You'd be feeling pretty good.
But we don't stop reading there. That's why we have a show.
Precisely. You have to look at the GAAP numbers. GAAP EPS was 34 cents.
Oof.
Now, compare that to Q4 of 2024, where it was 79 cents.
That's a huge divergence.
It is. We are talking about unadjusted earnings being cut by more than half. Now, there are accounting reasons for that. Discontinued operations with the China business, which we will get to. But when you see GAAP earnings cut in half while adjusted earnings are screaming higher, experienced investors start squinting at the adjustments.
It's the quality of earnings argument, right? When the gap between the adjusted number that management wants you to see and the real number gets too wide, people get very, very nervous.
They do. And the sentiment shift was immediate. The stock plummeted from around $70.70 down to that $66.35 level. It feels like the market looked right past the revenue beat and saw margin compression.
Yeah.
They realized that the sales growth is coming from places that are lower margin or harder to access, while the core cash cow of the U.S. franchisee is bleeding.
And to their credit, management didn't exactly hide from this. They were very explicit about the macro environment, especially in the Q&A and their prepared remarks.
Oh, yeah. They talked about the pressured consumer, specifically that lower income cohort. This is the value war we've been hearing about for 6 months now.
Just seen it everywhere.
We've seen it with McDonald's. We've seen it with Wendy's. But now we are seeing the casualties in the margin structure at QSR.
Okay, let's get into the weeds. I want to talk about the U.S. problem. Specifically, Burger King US. This is what we were joking about earlier, the profitless prosperity problem.
It's the perfect way to frame it.
Because if you just look at the top line, Burger King looks like it's winning.
It does. If you look at the top line for Burger King US, it actually looks like a success story. Comps were up 2.6% in the quarter and 1.6% for the full year.
And they're taking share.
They are. They have outperformed the burger QSR industry for 9 of the last 12 quarters. People are choosing the Whopper over the Big Mac more often than they were 3 years ago. The top line is moving in the right direction.
And we have to give credit where it's due. The marketing is working. They had a massive hit in December. I think we need to talk about the sponge under the sea.
The SpongeBob factor. It was huge.
The SpongeBob factor. The Krabby Patty promotion. I saw this everywhere. My nephews were talking about it. Management said it drove the highest kids' meal incidence in 10 years.
A decade. That is a staggering statistic for a legacy brand like Burger King.
It really is.
I mean, you have to understand the kids' meal demographic is the holy grail for QSR. If you get the kid, you get the parents, you get the whole minivan. For a decade, Burger King has struggled to be relevant to that under 10 demographic. SpongeBob fixed that in a quarter.
And it wasn't just a flash in the pan. They didn't just come for the toy and then leave forever.
Importantly, no. That was a key point they made. They noted that those new customers who came in for the Krabby Patty actually returned in January after the promotion ended.
So it had some stickiness.
It did. So the Reclaim the Flame marketing spend, that $400 million war chest they announced a couple of years ago, is doing its job. It is getting bodies through the door. And they stuck to their value strategy, the $5 duos, $7 trios. They avoided the deep, deep discounting wars that just destroy brand equity.
Okay, so the marketing is working, the traffic is there, the kids are eating Krabby Patties, but, and here is the giant but that crushed the stock today, it didn't translate to the bottom line for the franchisees. Why not?
It's the cow.
The cow.
It's the beef. And this is the bear case in a nutshell. Beef inflation. Beef costs were up over 20% for the full year.
20%. Let's just pause on that. If your rent went up 20% or your mortgage went up 20%, you'd be panicking. For a burger joint, beef is life. It is the central input.
Just think about the P&L of a burger joint. Beef is your single largest commodity input. It's bigger than labor in some contexts, certainly bigger than your utilities. When that one line item swells by 20%, it absolutely decimates your margins unless you can take aggressive price increases.
But they can't take aggressive price increases.
They can't because the consumer is weak. If they raise the price of the Whopper by 20% to match the beef, that customer goes to Taco Bell, or even worse, they just eat at home.
Right.
So the franchisee is stuck in the middle. They have these surging costs on one side and a very firm price ceiling on the other.
So the franchise eats the cost.
Exactly. And we have the numbers to prove it. Franchise profitability dropped to approximately $185,000 in 2025. That is down from about $205,000 in 2024.
And that is a critical threshold. Let's unpack the psychology of that number. $200K in EBITDA per store.
Yeah, $200K is often seen as that psychological safety line for operators. It's the sleep at night number. At $200K, you can pay your debt service, you can pay your royalties to corporate, you can take a nice salary for yourself, and you still have cash left over to reinvest.
Well, when you drop to 185...
When you drop to 185, things get tight. You start deferring maintenance. You stop looking for real estate for your next location. Your whole mindset shifts from growth to survival.
Management explicitly tried to soften this blow on the call. They claimed that profitability would have been flat year over year without the beef spike. They're blaming the commodity cycle.
They are, and statistically they are right. If beef had stayed flat, margins would look fine. But as an investor, and more importantly as a franchisee, you can't pay your bills with would have been.
Right.
The bank doesn't care about the hypothetical price of cattle. They care about the cash in the account. And the reality is, the cash-on-cash returns for building a new Burger King just got a lot worse.
And that leads directly to the news about the remodels. This was a major red flag for me on the call. It felt like a capitulation almost.
The modern image delay.
Yeah, that was a big one.
Right. The target was to have 85% of the system in the modern image, the new sleek look, the sizzle format, by 2028. What did they say today?
They pivoted hard. Management admitted this is going to take longer. They cited high construction costs and high borrowing costs. Currently, they are only at 58% modern image. This connects right back to the profitability, doesn't it? If I'm a franchisee making 185 instead of 205, and interest rates are hovering in the mid-threes for SOFR, I am not borrowing $1 million to scrape and rebuild my store.
No way. You're hunkering down. You're preserving capital.
And that slows down the entire flywheel. Remodels drive sales lifts. We know this. A new store does 20% better, sometimes more than an old store.
It does.
If you delay the remodels, you delay the sales lifts. It's a negative feedback loop. And while they're refranchising the Carroll's units, they did over 100 this year, which is ahead of schedule, the broader system is in a capital preservation mode.
It creates a tiered system, which is dangerous for a brand. You have these beautiful new sizzle restaurants doing $3 million in sales, and then you have the old, tired fleet dragging the average down. It creates brand inconsistency.
And investors hate uncertainty regarding CapEx cycles. This delay tells the market that the Reclaim the Flame plan is hitting a friction point with reality. It's not that the strategy is wrong, it's that the macro environment makes the strategy too expensive to execute right now.
That's it, exactly.
Let's pivot to the other U.S. headache, Popeyes. If Burger King is struggling with costs, Popeye seems to be struggling with everything in the U.S. right now.
Yeah, Popeyes US is the turnaround project of 2026. If Burger King is a margin story, Popeyes is a sales story. And the numbers were, frankly, ugly. U.S. comparable sales were down 3.2% for the year.
Down 3%. And system-wide sales.
Negative.
Negative system-wide sales is a growth stock killer.
Yeah.
That means the brand is literally shrinking in terms of dollar volume being processed through its stores.
It is. And franchise profitability there dropped to about $235,000. Now, that's still better than Burger King, but it's trending the wrong way. And there was a very uncomfortable moment in the Q&A regarding a bankruptcy.
Yeah, let's unpack that. A large franchisee filed for bankruptcy. Management tried to downplay it, right?
They did. They called it isolated. They said the rest of the system is healthy. But when you have comps down 3% and a major operator filing Chapter 11, the market gets very nervous about contagion. Isolated is a word CEOs use right before systemic.
It's a yellow flag at the very least.
At the very least.
So what is the fix? Because the chicken category is still growing. People are still eating chicken sandwiches. Chick-fil-A is doing fine. Raising Cane's is doing fine. Why is Popeyes losing?
Management was very candid here, almost surprisingly so. They admitted it's a service business problem. They were failing on speed and accuracy.
It's the operations. It's the blocking and tackling.
It is. They've brought in Peter Perdue, the former Burger King COO, to take over. And his diagnosis is that they just took their eye off the ball. They got distracted by non-core innovations, wings, appetizers, ghost pepper, this and that.
The menu got too complicated.
Exactly. It's a Cheesecake Factoryization of the menu. When you add wings with 5 different sauces and nuggets and sandwiches, the fryer management becomes a nightmare.
And speed slows down.
Speed slows down, accuracy drops, customers get annoyed and they don't come back.
So the strategy is back to basics.
Correct. Focus on the core, the bone-in chicken, the tenders, the sandwich, less noise, more execution. They are increasing the field operations team by 75%.
75%.
Yes. That means more corporate boots on the ground, standing in kitchens, coaching general managers on how to run a shift properly.
It sounds expensive.
It is expensive in the short term, but it's absolutely necessary. You cannot have a premium brand like Popeyes delivering subpar service when the competition is so fierce. You can have the best sandwich in the world, but if it takes 15 minutes to get it and the order is wrong, you lose.
Right, that's the U.S. gloom and doom. And that really explains the sell-off. If you just looked at the U.S., you'd sell the stock too. But QSR isn't just a U.S. company.
Not at all.
In fact, the international in the name is doing a lot of heavy lifting right now. Let's talk about the Great White North, Tim Hortons.
Tim Hortons Canada is the reliable compounder. It's the ballast in the ship. While the U.S. is rocking back and forth in a storm, Canada is just steady as she goes.
And the numbers bear that out.
They do. Canada comps were up 2.8%. And importantly, they outperformed the Canadian QSR industry by a full 2 percentage points.
And this is in a mature market. Tim's is everywhere in Canada. It's harder to grow, when you're already on every corner. Growing nearly 3% on that base is impressive. What's driving it?
It's a shift in consumer behavior that Tim's has finally captured: cold beverages.
In Canada, in the winter, I don't get it.
It sounds counterintuitive, but the data is undeniable. Cold beverages grew 8.6% in Q4. We are talking about December in Canada, snow on the ground, and people are buying iced espressos and quenchers.
That is wild. I cannot imagine walking through a blizzard with an iced coffee.
It's a generational shift. Cold bev is now nearly 27% of their total beverage mix.
27%.
This is the highest fourth quarter mix on record for them. This is the Gen Z and millennial shift. They don't want hot coffee. They want cold, customizable caffeine. Tim's rolling out these new espresso machines is paying off big time. They are finally competing with Starbucks on the treat occasion, not just the morning fuel occasion.
They also talked about the PM food strategy, trying to break out of that 6 a.m. to 10 a.m. stronghold.
Right. They own breakfast in Canada. Nobody disputes that. But the real growth is in lunch and dinner. So they are pushing these flatbread pizzas and bowls. The goal is to make Tim's a viable option for a 6 p.m. meal.
Is it working?
It's a slow build, but they are seeing incremental gains. And importantly, they are focusing on speed of service in the PM, which has historically been a weak spot. If you order pizza at a drive-thru, it better be fast, or you destroy the throughput for everyone else.
And then there's the partnership news. Canadian Tire. This is one of those headlines that if you aren't Canadian, you might have just scrolled right past it, but it's actually huge.
This is a fascinating strategic move. They are launching a loyalty partnership with Canadian Tire later this year.
For our listeners who aren't Canadian, explain the scale of this. What is Canadian Tire?
Canadian Tire is an institution. It's not just a tire shop. It's like Home Depot meets Walmart, meets an auto shop, meets a sports store. It has this cult following. Every Canadian has Canadian Tire money somewhere in a drawer.
It's a beloved brand.
It is. And by combining the Tim's Rewards pool, which already drives 33% of their sales, with Canadian Tire's Triangle Rewards, they are reinforcing their dominance.
It's a data play, isn't it?
It's a massive data play. Two enormous Canadian legacy brands combining their loyalty pools. The Tim's Rewards pool has 7 million active users.
That's a million.
By combining this with Canadian Tire's reach, they get a 360-degree view of the Canadian consumer. They know what you eat for breakfast, they know what car you drive, they know what hockey stick you buy.
And the franchise economics up there seem stable too.
Very stable. Franchisee EBITDA held steady at roughly 295,000 CAD. That's despite coffee commodity costs going up and some tariffs. It shows the pricing power of the brand and the efficiency of the model. Tim's franchisees are making money, which means they are happy, which means they aren't suing corporate.
Which is a nice change of pace from the U.S. side.
A very nice change of pace.
Okay, let's go wider.
Yeah.
International. This seems to be the part of the story the market is completely ignoring, or at least severely undervaluing today.
It is the real growth engine, without a doubt. International system-wide sales grew roughly 11%. That is double-digit growth at scale. If this was a standalone company, it would be trading at a 30 times multiple.
And the star of the show here isn't Burger King, surprisingly. It's Popeyes International.
Popeyes International is a hidden monster. It's an absolute beast. Management revealed the run rate is now $2 billion.
$2 billion from Popeyes outside the U.S.
That's right. It grew from $927 million in 2023 to $1.7 billion in 2025. That is a doubling of the business in just 2 years. The turkey market alone is exploding. They have nearly 500 restaurants there now.
That is incredible speed. Why is Popeyes working so well abroad when it's struggling so much in the U.S.?
2 reasons, really. First, the product. Spicy chicken is a global language. It travels much better than beef does culturally.
A good point.
Second, and more importantly, the assets. In the U.S., you have 30-year-old buildings with weird, inefficient kitchen layouts. Internationally, these are brand new builds. They are digital first. They have the double drive thrust. They have the optimized kitchens. They are efficient money printers from day one.
We also got an update on the China situation. This has been a bit of a headache with the restructuring, but it sounds like they've turned a corner.
They have. A big corner. Q4 comps in China were up 9.2%. That is a massive reversal from the negative trends we saw previously.
And they finally closed the joint venture deal.
Yes, on January 30th. They partnered with CPE, a Chinese investment firm. CPE injected $350 million of capital into the business. The goal is 2,500 units by 2030.
And this is crucial because it de-risks the balance sheet for QSR. They aren't funding that growth with their own cash. They are using local partner capital.
Exactly. It returns to the asset-light model that investors love. QSR just collects the royalty check, while CPE puts up the capital and deals with the local headaches. It's the perfect setup for a volatile market like China.
And we can't ignore Japan. Burger King Japan has beaten the industry for 11 straight quarters. They posted 22% same-store sales growth in 2025.
22%. That's tech stock growth numbers.
In a burger joint in Japan.
In a market known for being incredibly difficult for Western brands, Japan is notoriously picky on quality. It just shows that when the operations are right, and they mention the Whopper in Tokyo as one of the best in the world, the brand resonates. They treat the Whopper like a premium product there, and the consumer responds.
So we have this incredible dichotomy. The U.S. is slogging through mud with beef inflation and angry customers, while the rest of the world is sprinting.
That's the tension. And today, the market decided the mud was deeper than the sprint was fast. The market is saying, we don't care about Japan if the U.S. franchisee is going broke.
Let's talk about the future. They gave us the algorithm for 2026. This is their promise to Wall Street, their guidance.
They recommitted to the algorithm. They are guiding for 8% organic adjusted operating income growth.
That's the magic number, 8%.
It is. If they hit 8% consistently, the compounding takes care of the stock price. That's the bull case. And they expect unit growth to ramp back toward 5%. They admitted 2025 was the low point at 2.9% net restaurant growth.
So they are saying, trust us, the growth is coming back. This was a temporary blip.
Yes. They are also keeping G&A disciplined, expecting it to grow slower than sales in the $600 to $620 million range. So they're keeping the corporate belt tight.
But CapEx is going up.
It is. CapEx is increasing to around $400 million, and this is driven by those Tim's renovations in Canada and the Carroll's remodels they now own. They have to spend money to fix the assets. You can't cut your way to growth. You have to build.
And the dividend, the shareholder return piece.
Raised by roughly 5% to $2.60 per share. That's the 14th consecutive year of increases. So the yield is safe and actually getting more attractive as the stock price drops today.
That's a good point. For the income investors, this drop is actually an opportunity to lock in a higher yield.
If you believe in the long-term story, yes.
They identified some major macro themes on the call. The value war isn't ending.
No. They were clear that low-income consumers are pressured. Everyone is discounting. And importantly, for the U.S. story, they do not expect relief on beef prices until the second half of 2026.
The second half. So the first half of this year is going to be tough.
H1 is a headwind. Investors need to be prepared for another couple of quarters of margin squeezing in the U.S. before the cattle cycle finally turns. Don't expect a miracle in Q1.
And interest rates. What's the debt situation look like?
They noted that about 15% of their debt is floating, exposed to those mid-3% SOFR rates, and net leverage is at 4.2 times. It's manageable, but it's not cheap debt anymore. They are paying real money to service that debt.
Okay, so we have the picture. A beat on paper, a disaster in the U.S. beef market, a rocket ship in international chicken, and a stock that's down 6%.
That's the summary.
This brings us to our favorite segment of the show.
The part where we get hypothetical and a little reckless.
Exactly.
Yeah.
This is not financial advice. We have to say it. Do not sue us. Do not trade based on this. This is a hypothetical trade idea pitched with the confidence of a hedge fund analyst who just had 4 espressos and is trying to impress the investment committee.
We're just two people looking at numbers and having some fun.
Okay, what do we call on this one?
We call this trade the Canadian Tire Iron Condor, or perhaps more accurately, the beef-pocalypse spread.
I love it. What's the thesis?
The thesis is simple. The market hates the U.S. beef exposure right now. It is pricing QSR as if the U.S. margin squeeze is permanent and systemic.
Right.
But it is sleeping on the international and Canadian strength. The remodel delay news is a temporary capital preservation move that looks bad today but saves cash for tomorrow. So we think the market is overreacting to a temporary problem.
So the first leg of the trade is simple. We buy the dip.
You go long QSR equity. You are buying the 6% drop because Tim's and International are bulletproof. That $2 billion Popeyes international run rate is essentially being mispriced or completely ignored by the street today. You are buying the growth engine at a valuation.
But what about the beef? What if we're wrong? What if cows get even more expensive? What if the herd shrinks further and prices spike another 20%? That would kill the stock.
That's the hedge. And this is the wild part of the trade. You short-live cattle futures, specifically the April 26 contracts.
Short to cows.
You are literally shorting the cows. Here's the logic. If beef prices crash, as we eventually expect them to, your short on the futures pays off massively. But if beef prices crash, what happens to Burger King's margins?
They explode upward.
Exactly. Franchise profitability recovers, the remodel machine turns back on, they start building units again, and the stock rips higher. You win on the futures and you win on the equity recovery. It's a beautiful, beautiful hedge.
And if beef stays expensive for a while?
If beef stays stubbornly high, your equity position might drag a bit, sure. But the international growth, which sells mostly chicken and coffee, continues to compound and offsets the U.S. beef pain. And eventually, QSR will either pass that pricing on or shift the menu mix more aggressively to chicken. The business will adapt.
Is there a kicker? There's always a kicker.
Always. You buy calls on Canadian Tire or a Canadian retail ETF if you want to be safer. The loyalty merger creates a data monopoly on the Canadian consumer that the street is currently valuing at exactly zero. When they start cross-selling tires to coffee drinkers, that synergy value is going to show up in the earnings for both companies.
So to sum up the trade, long QSR stock, short cattle futures, and long calls on a Canadian retailer.
You're playing the protein deflation trade disguised as a fast food play with a Canadian data kicker.
I love it. Again, don't do this at home. But if you did, you'd be the most interesting person at the dinner party.
And likely the most diversified against herd dynamics, literally.
Literally. All right, let's wrap this up. Let's bring it home.
To recap, QSR posted a beat, but the street punished the quality of the earnings. The U.S. turnaround is fighting massive commodity headwinds. That 20% beef inflation number is the only number that mattered today.
But International and Tim Hortons are carrying the backpack. They are the adults in the room, ensuring the algorithm stays intact and the dividend gets paid.
Management says 2026 is the year they return to the algorithm. The market is saying, show me the margins first. The next catalyst is the Investor Day on February 26th. That's where they have to convince the street that the U.S. ship can be righted.
We will be watching that one very closely. Until then, keep your eyes on the tape and your lunch orders cheap.
See you next time.